So welcome back everybody. Now let's see your Excel model concerning our bond. Here in the beginning in the third row you can see that I wrote that it's the bond pricing formula. And why is it important? So if you want to invest in a bond and you want to know its price, how much value it actually carries, then you will have to compute its present value. Here you can see the present value formula, which might be a bit too complex, but I will explain it. So you can see that in each year, the expected cash flow is divided, or in this case, discounted by a rate, which is R in this case. And here in the first year, you can see that it's the same rate as it's in the second year and also in the last year. Now in this case, we say that the R is the expected return from the bond. So let's say you invest 100 million euros. The expected return is like, I don't know, 3%, then it will be 3%. And why do we vision? Well, if you want to compute the price of the bond or the value of the bond for today based on the future cash flows and the face value payment, then you will have to actually discount back these cash flows with the expected rate of return of the bond. So in this case, you will get the present value, which is PV in this formula of the bond. So here you can see this color cell. I also wrote here is the sensitivity. So these are the cells which you can change. Now, here you can see in the 14th row that I wrote it's a discount rate. So for example, we expect a 5% return from the bond. The tenor is 4 years, it's unchangeable because here in this chart which I have created, it takes up only 4 years. Obviously, most bonds take up a way longer tenor, but I think it's easier to oversee such credit instruments if we have last year's to analyze. Here the coupon rate is 6%. The coupon is actually the interest rate that is paid by the client to the investor throughout the tenure of the loan. And the face value, which is the capital amount of the bond or the loan, is 300. And here you can see the cash flows of the bond investments. In the first year, you buy it, so it's minus 300, and you don't pay anything concerning the investment throughout the tenure. Then the issuer pays back 18, which is basically computed by multiplying the coupon with the face value. Each year is 18, and the face value payment is paid back right at the end, so as a bullet. And you can see it if I sum up the cash flows in the 23rd line, that's how they look like. The present value, in this case, computed by a long formula, which can be seen here, but it's not really easy to follow with because basically I manually wrote this long formula here, which computes the value of the coupon bond in the current moment. But there is another methodology which is often used by financial analysts in banking, and it is in this chart. Here you can see that you can divide out the tenure 4 years. Here you can see the cash flows of the bond. In the first 3 years, it pays 18, which is basically the coupon. Here it pays back in the 33rd row the face value and the coupon. And then you just simply divide with the expected rate of return the actual cash flows. And in each year, we have a different value. We can call the discount factor. So this is the factor which actually discounts the existing cash flow of the bond. And if we multiply it with the cash flow, then you will get for each year the present value of the asset, and if you add up them, then you can get the same value as it is here. So it's not that easy formula, but I think it's easy to oversee the computation methodology here in this chart. So after this video, you will have the opportunity to go through this model again, and hopefully you will understand it deeply, how these bonds work. So this was the evaluation of a coupon bond. Let's go now to another type of bond, which is the discount bond. Actually, these are also bonds, but the difference concerning discount bonds and the coupon bonds is that discount bonds do not pay any interest rate or coupon throughout the period of the bond. And here in the 44 show, you can see that it's not paying anything and only pays back the face value in the last year. And how can it be profitable for you? Well, the case is that you basically buy it cheaper than the face value. So, for example, here you say 80, and then the difference, and you will get back at the end of the tenure the face value, which is 100, and then you can see that you have an absolute return of 20, which is also can be computed as a 20%. So this is an also a widely known and widely used financing instrument, a discount bond. I think it's really important for you to understand it as well. And also I computed here that in this case, purchase price concerning the face value, the auction that can be computed as 20%. So thank you for your attention and see you in the next section.